We will now give the floor to Francesco Mazzaferro for the SUERF Annual Lecture. Francesco Mazzaferro is head of the European Systemic Risk Board Secretariat from its inception 10 years ago. Francesco, please, the floor is yours.
Thank you very much for the invitation. I will speak on behalf of the European Systemic Risk Board. Ladies and gentlemen, the economic contraction that we have seen in 2020 has been unprecedented in recent history, excluding war periods. The fall in GDP has been much larger than those seen in the global financial crisis or even during the oil crisis in the 70s. At the same time, uncertainty prevails and relates to two crucial aspects of the pandemic. First, the evolution of the pandemic itself. Europe is now fighting the second wave after the summer with limited number of infections. And two, the impact of the containment measures on economic activity and how economic agents will be able to adjust to them. In view of these levels of uncertainty, economic agents have behaved and continue to behave with caution. We have seen savings of households reaching levels not seen before in statistical time series. Consumption has decreased abruptly, particularly in those sectors more sensitive to the pandemic, such as accommodation or restoration. The policy response has been commensurate to the severity of the crisis as involved fiscal, monetary, and prudential authorities. Through this effort, the significant turmoil in March and April did not lead to a systemic crisis, which would have worsened the dramatic effects of the pandemic. However, the impact of COVID-19 pandemic is still not clear visible in the balance sheet of the European banks, mainly for two reasons. The first one refers to the usual timing of stress in the real economy to translate into losses to be absorbed by banks. As you all know, increases in unemployment and corporate insolvencies follow quickly after the onset of a recession. To the contrary, it then takes time for the related households and non-financial corporations to default on their bank loans. After all, the definition of non-performing loans as main criteria non-payment over 90 days, and the other criteria is the assessment of the borrower to be unlikely to pay. The second reason of this delayed effect on the balance sheet of bank is related to the policy response I've referred to before. The uptake of loan guarantees and moratoria have eased the financial stress of households and non-financial corporations for some time. Indeed, if we observe the number of reported bankruptcies in 2020, it is not possible to find any sharp increase derived from the outbreak of the pandemic. And in many cases, in fact, we have even historical lows. At the same time, in the near future, the stress faced by households and non-financial corporations will probably inevitably lead to an increase on forborne, renegotiated loans and non-performing loans. Why it is so? As you know, while government guarantees loans shift the ultimate risk bearer to the government, the share of these loans over the total loans differs significantly from country to country. Is small in any case in comparison with the outstanding amounts of loans. From a financial stability point of view, one of the issues which is most important for us, the finalization of loan guarantees and moratoria is of particular concern, as it may generate a cliff effect and increase the intensity with which stress in the real economy is transmitted to the banking system. The ESRB is carefully looking at the financial stability implication of the exit strategy from support measures. Deteriorating asset quality will translate into higher provisions, taking a toll to the profits and loss account of banks, and then directly to the potential use of retained profits to increase their capital positions. These are things which are known and have been already reflected in particular in what has been happening in the first part of this year. As part of the response by the ESRB to the COVID-19 outbreak, a recommendation was issued in May restricting distribution by financial institutions in the EU. In view of the significant uncertainty about the length of the COVID-19 crisis and about its severity, the ESRB saw a need for financial institutions to maintain a sufficiently high amount of capital to mitigate systemic risk and contribute to economic recovery. The recommendation is precisely addressing those actions by financial institutions that can result in a decrease in the amount and the quality of their own funds, or in the reduction of their loss-absorbing capacity. These actions include dividends, variable remunerations, and paybacks of ordinary shares. The recommendation is applicable until 1st January 2021, and currently the ESRB is weighing up the pros and cons of further actions in this regard. In doing so, it is fully coordinated, of course, with its member institutions, including micro and macroprudential supervisors. Looking ahead, I would like to offer some thoughts about the main issues affecting the EU banking system in the short to medium run. Some of these issues, you see them on the top of the slides, are directly linked to the COVID-19 pandemic. They refer to corporate insolvencies, to the usability of capital buffers, to the use of recovery and resolution frameworks, and to the use of stress tests and balance sheet transparency. Other issues, which I will refer to, are more systemic and structural in nature. Let me start with the main challenges faced by the banking sector derived from the COVID-19 pandemic, and in particular with the issues of insolvencies. Loan moratoria and other support measures to households and non-financial corporations will need one day to be phased out. These measures have been crucial to contain the economic and financial impact of the pandemic, but they cannot be in place forever. Since they are phased out, the financial soundness of the non-financial corporations will be revealed, with the potential to lead to a large wave of corporate insolvencies. To the extent that banks lending is the main source of funding of European corporations, particularly for small and medium-sized enterprises, the expected large number of insolvencies can create substantial stress in financial systems. In this regard, there are three important questions to which we as macroprudential authorities need to answer. First, what do we know about a likely path of corporate insolvencies? Which sectors are going to be more affected and at which pace? These are crucial issues to identify the issues at stake, whether it is going to extend over time or whether it's going to be one-off events. Some academic publications have tried to look at this issue and have come with valuable findings for this task. Second, do insolvency frameworks around Europe have the capacity in terms of resources and absence of bottlenecks to deal with an elevated number of corporate insolvencies at the same time? Here, it would be crucial as well to avoid bringing viable but illiquid corporations into insolvency, do a flawed assessment of the long-time viability of the corporations. Finally, is there something we can learn from each other in terms of best practices? This is the most relevant aspect for policymakers, since we could take policy actions based on the experience in other jurisdictions in the past. Let me turn to the usability of capital buffers. Prudential authorities have taken important policy actions to offer regulatory relief to banks. This made possible for credit institutions to use their own funds associated with capital buffers to maintain the provision of credit to the real economy in the current difficult circumstances. Despite this effort, there is a perception that some capital buffers introduced by the regulatory reform after the global financial crisis are not usable in practice. We need time and data to look carefully at this, and if appropriate, consider how the current regulatory framework can be improved so that capital buffers are used when needed. Do not forget that the main goal of capital buffers, after all, is to absorb losses. Finally, in this assessment, it is important to consider how the risk-weighted capital requirements interact with the leverage ratio and with the MREL requirement to avoid unintended outcomes from the combined application of the three. Third issue is the application of recovery and resolution framework in the COVID situation. The ambitious and large support measures taken by the governments to support the economy in view of the COVID-19 pandemic have, for sure, mitigated the impact of the financial system. However, given the unprecedented size of the shock created by the pandemic, and despite of the action of monetary policy, they might not be enough to avoid a weakening of the economic environment and to add pressure to the financial soundness of banks, testing their resilience. For some banks, it may be possible that there is a need to trigger recovery and resolution actions in a concentrated period. Given these challenging perspectives, I think it is necessary to carefully assess from a macroprudential perspective, considering the banking sector as a whole, the different alternatives to dealing with forthcoming difficulties in the banking system that are derived from the COVID-19 pandemic. The issues to consider here are wide-ranging and important. For instance, the current recovery and resolution framework has not been used through a systemic crisis, with several banks experiencing difficulties at the same time. It is important to understand how the framework can work in such conditions and whether there are actions to be taken to enhance it. Besides, other solutions for ailing banks may involve precautionary recapitalization and asset management companies. For that to be fully operational, if needed, of course, we need to make sure we are aware of the implication of these actions in terms of state aid. There are many other issues to be considered in this area to help us understand the toolkit available, the financial stability implications of each tool, and the interaction with other regulations. We need to use the time available to us to advance in these areas, hoping, of course, that we will not need to put our findings to work. Finally, concerning stress test and balance sheet transparency, an important element to consider when thinking about challenges for banks and the regulatory and supervisory authorities in particular in this time, refers to what should be the design of the stress test scenario for the BA stress test, which, as you know, is produced by the ESRB. While during normal times, stress tests try to identify possible build-up of risk, during crisis periods like the one we have now, stress tests are key in building confidence among market participants that banks subject to them are resilient enough to absorb losses to materialize in the short term. Designing a scenario in these circumstances is more than ever not an easy task. On the one hand, it is clear that the scenario must reflect the impact of the pandemic on banks, and also quite importantly, the scenario needs to find a balance between severity and plausibility. Having a very severe scenario that is, however, not plausible would make little service to financial stability in the EU. In order to gain confidence on the EU banking system, transparency of bank balance sheets is also crucial and complementary element to stress test. To that purpose, we must ensure that financial information is accurate, timely, and relevant, in particular in the current times characterized by uncertainty. In more structural terms, before the outbreak of the COVID-19 pandemic, there were concerns about the banking system. The macroeconomic environment, low interest rates, low growth, and low inflation was fundamentally challenging the traditional business models of many financial institutions across the EU. In the case of banks, these challenges were combined with existing structural weaknesses referred to legacy assets from the global financial crisis, excess capacity, often referred as overbanking, and inefficient cost structures. As a result, profitability of EU banks had been much below international peers for many years, and equity valuations of EU banks were also subdued. The majority of EU banks were trading with price-to-book ratios below 1, typically seen as a signal of small confidence from investors. Moving ahead, responding to these challenges would be key for the EU banking system to emerge as a sound and to contribute to the recovery from the pandemic crisis. Real estate exposures are particularly important in the lending portfolio of banks in Europe, and as this was demonstrated in some countries during the global financial crisis, can be an important channel of contagion between the real economy and the financial system. In 2016 and 2019, the ESRB issued several warnings and recommendations to EU member states focusing on vulnerabilities related to residential real estate. In addition to them, it has published several assessments in the last years covering also commercial real estate. The ESRB is regularly assessing the financial stability implications of developments in real estate markets, also in the context of the assessment of compliance with its warnings and recommendations. For the future assessment, the structural changes imposed by the COVID-19 pandemic may need to be considered. For example, the extension of remote working modalities may impact the demand for commercial real estate. These are important developments that need to be carefully assessed from a financial stability point of view. Let me now conclude. Our economies are currently suffering an economic shock caused by the COVID-19 pandemic that we have not seen in the last 100 years, excluding periods of war. While banks have not yet suffered material losses from this shock, they will become affected by it, as other financial institutions will be. I've outlined 4 policy areas: insolvencies, capital buffers, recovery and resolution, and stress tests, directly related to the COVID-19 pandemic, where regulators and supervisors, together with banks, need to take action to ensure the banking system is best prepared to absorb the losses from the COVID-19 shock and to ensure the flow of credit to the real economy. The way our banks absorb this impact and how they address existing structural vulnerabilities, challenges to traditional business model, excess capacity, legacy assets, is going to determine the banking system of the future. I hope this is a banking system that is sound and positively contributes to the economic recovery from the COVID-19 pandemic. Many thanks. Thank you.
Thank you very much, Francesco. We have a first question for both speakers, Jean-Pierre and Francesco, which is the two sides of the same coin, low profitability. When we speak with bankers, the narrative goes that negative interest rates and narrow margins, together with the cost of the regulation, are part of the explanation. When we talk with regulators, supervisors, the emphasis is placed on the legacy assets, which were unproductive in the form of NPLs, and the lack of efficiency. Then we have in the future the dream of bank consolidation that seems to be the holy grail for the solution for the problem of low profitability. Where do we stand?
On the low profitability question, I think that we have a combination of various items. I mean, banks can always cut costs more and be more efficient. That's a fact of life. But if you look at what European banks have been doing in the past years, and if I'm looking at what we've been doing at Unicredit, I mean, between the two plans we are cutting our workforce in Western Europe by 25% and cutting our branches by 38%. So it's a massive adjustment, okay? Nevertheless, profitability will remain low because of negative rates and because of low growth. I mean, low growth means that the client activity is subdued and negative rates are impacting, our net interest income. So, I don't think, the answer to low profitability is to say that banks need to cut more costs. It is part of the answer, and it's a consequence of the transformation of the business model. And this transformation should accelerate because of the COVID crisis, because clients are using more remote banking. But all in all, there is a structural low profitability of banks in continental Europe, in the negative rate Eurozone, because we have low growth and negative rates. And the more it lasts, and the more we have actions which might deter investors to invest in banks, I mean, the more banks are going to trade at a low price and will have difficulties to attract capital. The fact that banks trade at a discount to tangible book, is not because of a risk problem. It's because of a structural profitability problem, which with negative rates is now structurally well below 10%, where the cost of capital is well above 10%.
Thank you. Francesco, your reaction to the same question?
Well, let me say, of course, I'm speaking everybody speaking in its own institutional capacity. And one of the things which is very important to to explain, I'm not speaking on behalf of the EBA. I'm not speaking on behalf of the SSM. I'm not speaking on behalf of the ECB. So I'm speaking really from a macroprudential angle. And there, I would like to say, first of all, that I have a lot of respect for what the banks have been doing, and I am completely aware of the difficult situation in which the banks have, of course, also for the low level of interest rate, but also because we have been starting objectively from a very difficult situation, clear overbanking in Europe. So I do not have a magic solution to what the banks could do. I agree with you, Gonzalo, of the fact that banks are in this moment part of the solution. I have somewhat impression that banks have asked to do several things, sometimes also a bit in contradiction one with the other, because they are used a bit by governments as transmission channels for their policy. At the same time, we from the macroprudential side or from the microprudential side, we are coming to ask for more efficiency. We are asking for transparency and this type of things. But honestly, I don't think it is my role now to give you specific, so to speak, guidelines on how you should manage your business.
Just to answer to that, there's unfortunately, if I may say, nothing specific to do except for banks to keep transforming because their clients are changing. So they will keep being more efficient by developing more remote banking, and for hopefully the economy, to grow more in Europe. When you compare the profitability of US banks and European banks, I mean, the differential of profitability comes from the GDP and the interest rate curve. That's it. US banks are not, meaningfully better managed than European banks. Just the macro environment, which is better for them. So we have to be patient and keep transforming is the answer.
I think, Ernest, you also might have a question.
I think we were very successful and consistent in the areas of monetary policy, macro and micro prudential policy, and also regulation, to act together very well in order to fight the COVID-19 shock. So all policy areas, including also fiscal policy, acted in an expansionary direction. Now the question is, Francesco, you mentioned asset price exuberance maybe in some areas, stock prices, some real estate sectors. Given these asset price boosts, might macro-pru at some point need to reverse direction?
In this moment, I don't know, but if I knew, I would say in a very selective way. Very, very often problems of, so to speak, of coherence or consistency are solved by nature. I have the same boss as the president of the ECB. I would be very surprised if Madame Lagarde were coming to very largely different conclusion as the ECB chair and SESRB president. Of course, we are taking issues related to as I will say, to commercial real estate, residential real estate very seriously, in particular in certain economies. Sometimes the answer, by the way, is not anymore represented by the fact of increasing buffers. There are situations in which buffers have been increased to the maximum. I'm thinking of issues in Scandinavia and so this type of things. It is more a question which has to do with let's say reducing tax advantages and other distortions which have been probably artificially fostering some sectors. So I think we will be very, very prudent in this respect.
Okay, and somewhat related, the last question, Francesco, is about precisely the macroprudential toolbox. And during this crisis, the question has been raised whether there should be a review of the macroprudential buffers. What is a very specific case in Europe where there is a multiplicity of authorities that have somewhat overlapping instruments to deal with similar risks. There are some voices asking about the possibility of releasable buffers instead of having the fixed stack. What is the current thinking? What can you tell us about that?
We have a deadline. This deadline is exactly the revision of the macroprudential framework for 2022. We have already started to work on this. We had already done it to a certain extent in the pre-COVID world. Now we have to consider also what has been the experience of the COVID world with the question of the usability of buffers, to which I referred. I think it's very important, however, not to confuse different issues. So, for instance, there is a home host dimension of this, which is a very separate question. There is a question, if you want, of coherence between the buffers, which is a different one. All in all, however, I don't think that the experience to which we have been confronted has been an experience of, let's say, of contrast or specific war among supervisors and so on. All in all, I would dare to say that the relations between the supervisors in Europe have been much more cooperative than sometimes in the United States.
Then I would summarize with 4 sentences that I think represent very much the state of things. Banks have to remain investable. We need predictability in these times of uncertainty. We need to transform the business model of banks, and we need to contend with the issue of home host and the coherence of buffers. That could be also the subject to a future discussion in these or other forums.